Good afternoon, everybody. Welcome back to Markets for Millennials for the weekly market wrap from April the 25th through the 29th. This was the last trading day of April, so we have the monthly close that just happened about 2.5 hours ago, and we're going to be heading right into May, which if any of you have been in the markets for a little while, you have probably heard the phrase "sell in May, go away." So I'm sure that to some extent there are people who might be looking ahead at possible selling to take place prior to the summer months. It's something to look out for. You never really know. Things don't necessarily always have to happen the same way, but we're going to take a look at the markets and what has been a pretty pivotal week, ending rather sourly today. We have some big news coming up, or some big, a big event coming up next week that will be big news, and that's the FOMC meeting for the month of May that we have coming up here on Tuesday the 3rd and Wednesday the 4th, with the press conference coming at, I believe, about 2:30 p.m. With the press release coming 30 minutes prior to that, where Fed Chair Powell will speak. And I'm sure there's going to be people with a lot of questions about or for the Fed. The real question is, we've had some chaos over the last couple of weeks regarding or because of FOMC statements. I talked about this in my previous update last week, where we had some discussion about multiple 50 basis point rate hikes, and the idea floated that a 75 basis point hike might be necessary. And what I am presenting to you today, obviously you never really know, but the question that I'm asking is, are we rolling over into the FOMC meeting next week? And one of the things that I posted on Twitter, because I a few days ago on Wednesday, I posted big stuff coming up the next few weeks, because we've had some pretty big earnings reports this week with all of the FANG names. And then I put FOMC May 3rd and 4th, and then April CPI on May 11th. So we have a couple of very significant newsworthy events coming up. And actually, I didn't even include the non-farm payrolls, which will be, I believe, on that Friday in May. So so that would be, I think, May the 6th. So that's even coming, and I completely forgot to mention that. So we have a lot going on. And just to kind of give you an overview of what I have been thinking about, and I posted about it here, I don't know how every rally doesn't get sold, at least until the FOMC meeting. And so I said the market tends to trend into what it is expecting, and then by the time the event takes place, it all has been priced in. So, so here's kind of where I'm coming from, because over here, let me try to highlight this, because over here we had the various members of the Federal Reserve and other central bankers around the world discussing the need to really rein in inflation, and that they're actually behind the 8-ball. That was a surprise. I mean, in reality, we all know that the central banks are behind inflation, but they've never admitted it up until this point. They said it was transitory, and then they said, oh, we see elevated levels, and we're just going to make sure it doesn't become entrenched. I think those were Powell's words a few meetings ago. And when this happened, right, we had obviously we had this bounce, and it looked like we were going to settle in and find the 50-day moving average approximately kind of around this level. It looked like we were going to find it as support, and then we were looking like we were about to resume off, came into those 100 and 200-day moving averages, and then that was when basically all hell broke loose. And the market was not expecting anybody to be talking about, I mean, the market was kind of expecting 50 basis point rate hikes. We've kind of known that around this area that there were potentially going to be multiple 50 basis point hikes this year. And that the Fed was committed to raising rates. But over here, we got not just the Fed talking about those, but also other central banks talking about ending purchases. Like the European Union has been way behind. The ECB has been way behind, I should say, and they are still making asset purchases and still haven't really raised rates, but they're talking about doing it earlier, doing both of those earlier than they originally planned. And the market was not expecting all of that to transpire, nor was it expecting to hear 75 basis points. And whether or not you think it's going to happen is irrelevant. The fact of the matter is, and this is kind of my base case right now, and the reason why I'm asking, are we going to roll over? Are we going to fade every rally until the FOMC at least? I've been thinking about this for about a week now, and the reason why is because the market prices in what it knows and what it expects. So the problem right now is that we're fairly certain that we're going to get at least one 50 basis point hike, and probably multiple of them. But the market was not expecting and does not know if we're going to get 75. So we're in this kind of area where we're not really, the market really hasn't decided if we should be pricing in 75 basis points or not. And I think because of that, every rally is going to get faded. So I suspect, like, maybe on Monday we get a bounce, maybe on Tuesday we get a bounce. I don't really know, but I suspect until Wednesday's press conference, that I think we're going to head down further to the downside. That's just a guess. Obviously, anything can happen. But we had a lot of people celebrating what happened yesterday. We had the S&P up over 100 points on the day, and then today we gave all of it back plus more, and we ended up finally on the S&P. We had barely previously on the 26th, earlier this week, we had barely missed making a lower closing low. We wicked lower, but we didn't close lower. Now we definitely closed lower than our early March and mid-March candles. So we haven't wicked lower than February 24th on the S&P. This is obviously looking at the E-mini futures. But I think every rally all these rallies are getting sold, and I think we're going to be heading further to the downside until the Fed gives us clarity. Now, what I suspect will happen is I think we're going to get a couple of down days. Like I said, I think the most obvious thing to happen would be on Monday we get another little green bounce, but then we sell down on Tuesday, and then on Wednesday we're down. And then if we do not get 75 basis points, then the market will probably rally on that. I could totally see if they're saying, oh wow, that's really bad. So if we're not sure about 75, and then they come in and say, no, we're not doing 75, we're doing 50 instead, I think the market will rally. We'll get another bounce, and then we're going to come into kind of a zone right around here where I'm going to be looking to see if we get rejected or if we can continue to march higher. If we do get 75, I don't think that's going to happen, but if we do get 75, then I think we'll probably chop a little bit until Friday's non-farm payrolls, and then we'll either go up or down for a little bit, and then we'll be looking at the CPI, and we're going to start to see, and I think that CPI, that CPI report for April, is going to be where we start to finally answer the question of, is inflation in terms of CPI peaking, which obviously that's a misnomer, because the CPI is a year-over-year metric. It's not a metric of how much your money has lost its value for a long period of time. It's just how much it's lost its value compared to the previous year. And so it's a rate of change mechanism or measurement. So I think that's important to remember. So you have to be aware that, if inflation as far as the year-over-year metric does peak and start to come down, then there will be all sorts of celebration and people saying, see, we did it, we're bringing inflation down, we're bringing it under control. And if the CPI were to fall below expectations, then I think we'll also see, actually we might not see a bounce, because then that would suggest that that the FOMC is handling things properly, and is still going to continue still going to continue raising rates and all that. Now, I think that the bounce on the bounce yesterday had a lot to do with the fact that our GDP report came out, and it came out negative. And if you have two negative GDP reports or negative quarters of GDP in a row, then that is the recession. And I posted about this on Twitter. I know I've been staying on the same chart for a while, so thanks for hanging in there. When we had the yield curve inversion, if I remember correctly, the yield curve inversion was, I should find the post. Let me go find my chart real quick. I think it's right here. That is not the right chart. So the yield curve inversion happened on April 1st as far as closing. Maybe if you wanted to say March 31st, that it wicked below. But in any case, that was when we got our yield curve inversion. And so if that happens, if we get another negative GDP report at the end of the June quarter, then that will have been the quickest that we ever got a recession by official standards, by official definition, following a yield curve inversion. And I think what happened was on the 28th when we got that negative print, because we got the yield curve inversion, or I'm sorry, because we got that first negative print, I think the market is expecting that we're going to get another negative print, and that the Federal Reserve is on their way to breaking something quicker than expected, and that they're going to end up having to come in to save the markets and flood the system with liquidity again. And because I honestly can't think of any other reason why we got this bounce, such an extensive bounce. I mean, like if we go to the Nasdaq really quick, this bounce was, it was a 3.43% bounce, pretty substantial. I mean, even more than the S&P. So that's kind of where things are at now. Again, because we made the lower low closing, I think that this is the alarm bell, unless we get a dovish surprise from the Fed. I can't imagine that we're going to get a really significant bounce, or that things are going to be looking bullish in the end. It could take a long time for this to happen. That doesn't mean that it's going to waterfall. A lot of people, I think, are looking for the waterfall. It could be more of a chop like this, which I think would be the most painful, because I think that there will be so many places where people are going to be thinking, oh, this is the bottom, I'm going to take a long, or you're going to have other people who, or you're going to have other people who, what the heck? Sorry. You're going to have other people who are going to preemptively take short positions, and then we're going to get little bounces that are going to stop people out, and it's going to be a mess. I think that would be max pain. But then traders, man, that would be a trader's paradise, honestly. Not my paradise, but that would be a trader's paradise. So another thing that I wanted to call attention to is that the 100-day moving average at today's close showed a cross. So we've confirmed the cross of the 100-day below the 200-day. And so that's kind of a big deal. In the past, occasionally those moments can be good buying opportunities. So like one thing to look at would be right here when we got that cross. It looks like on May 6th of 2020. But the difference is that the market had already come back more than 50% from its drop. So that obviously the circumstances were different, and during this period of time, and this is where you have to have contextual understanding. Right here, the Fed was flooding the market with billions of dollars in liquidity every day, making billions of dollars of asset purchases on a weekly basis, not even on a monthly basis. I mean, we're talking like weekly and in some cases daily. So there was a lot more easy monetary policy happening over here. In other situations, once you get that cross here, again, we were kind of on the upswing in 2019. This was after the pivot, after the Powell pivot, after the 20% decline. So again, different kind of situation where the Fed was, reversing policy here. And then when you go back prior to that, the last time we got a close was in 2015, September of 2015, and that when that crossed, the markets didn't make a new all-time high until, let's see, where's the all-time? They didn't make a new all-time high for almost a year after that. And so we could be looking at a prolonged sideways period. Here's another time we had a cross. That ended up being a pretty good buying opportunity in, what is this, in 2011. But this is also a time where there was a Fed pivot and another injection of QE, 2010, I believe. So the big one that a lot of people have been paying attention to is what has been the price action in the great financial crisis. And so when the 100-day moving average, once the crisis started, when the 100-day moving average crossed, we didn't make a new all-time high. Let's see, I'm gonna have to like really zoom out here. I know I'm going into a lot of price history and this is taking a really long time, but let's see where that cross happens. Making a new all-time high didn't happen for, wow, almost 2,000 days. I don't even know how long that is. That's into 2013, so we're talking almost 6 years later. So all that is to say, it's a really significant time. We could be in for a lot of pain, but obviously a lot will depend upon what the Fed does and how much the market has already priced in. We'll take a quick look at the Nasdaq. The Nasdaq clearly making a lower low than our March lows. We are now, I believe, let me turn my magnet back on for a sec. Today's close has us down now 22.23%. So bear market, which we already had from the March 14th close, we already hit that low. The Dow is the only one that hasn't made a lower closing low compared to its March low. So we'll be watching for that next. And I realized I gotta change these colors on these resistance levels. Sorry, that makes it really confusing. But we've also had crosses on all the major moving averages. The Russell fell below. I put this green dotted line below here. I don't know if you can, how well you could see that. But I put this dotted green line because this was marking the closing low from back in January on the 27th, and the Russell hadn't made a lower closing low, but it did this week finally. And I think that that's something to pay attention to. Obviously, all of its major moving averages crossed a long time ago. They had been in a range, real tight in a range for a while, and they are all pointed down, so momentum long-term is down. But the reason why I make a big deal out of this is because I think what's interesting is to see the correlation between the Russell and Bitcoin, which also has not made a lower closing low since January. And so the fact that it is now, I think that is a warning sign, although I'm not calling for Bitcoin to make a lower closing low, but it could happen. I mean, it's just something I'm noticing, just something I'm talking about, and I know that there are others on Twitter who have been trying to call that out as well. Let me go to the dollar index. I'm going to turn my moving averages off. I've been getting a lot of heat on Twitter, and because a lot of people are looking for that reversal. Here we are looking at the DXY closing today at 103.212. And let me go to an 8-hour. That makes it a little easier. A lot of us have been watching some various ascending trend lines. So if I just pull this out for a second, you can see the main trend line, which has been going on since May of 2021. So we're almost at a year since that trend started. And then as we come closer, we have a little bit of a steeper trend line, which is connecting from February 10th. Some of the lows around the 21st and 22nd of February, the lows at the end of March, and that trend is still intact. And then I have another trend line which I drew from March 30th and 31st connecting to a wick low on April 21st. And then finally I just recently put in this trend line using the 8-hour chart from April 21st connecting the wick to April 26th. We broke below that and have closed below that. And so obviously the parabolic move, the parabolic trend line has been broken, but that by no means that doesn't mean at all that we're reversing. And so, I mentioned that I've been getting a lot of heat from people on Twitter, and that's because everybody's looking for the reversal. So I want to point out this. People have been, my basic argument, and I just want you to understand, like, nobody knows what's going to happen, but what I'm having a hard time with is everybody saying, oh, because the dollar is at this level, it can't go higher. It's got to reverse. And I've been saying for weeks, I do think eventually it will reverse, but now is not the time. So, people are continue. Let me show you this picture. People continue to draw lines on charts. They're drawing, trend lines. If you follow my mouse, they're drawing trend lines. They started them here, over here. This trend line is drawn from 2016 to the crisis spike and all that. It broke through that. And my point is that the trend is your friend, as they say, and the trend is up. And everybody keeps finding lines that have to hold as resistance. Everybody's convinced that these things are just gonna hold, and they might not. So you've even got people like drawing trend lines going back to the early 2000s, and they're connecting trend lines like this, and they're like, oh, sorry, it's supposed to be something like that, and they're like, oh, this trend line is going to hold, and well, it didn't. So my point is that people are so hopeful, because a lot of people have basically decided that the markets like the equity markets won't go up if the dollar is strong, or gold won't go up if the dollar is strong, or Bitcoin won't go up if the dollar is strong. And the reality is like there have been like plenty of times. I mean, think about it. The dollar has been on an uptrend since May 2021. And, if you go back to the equity markets, well, look at that. The equity markets we're also on an uptrend for a really long time. So the point is that just because the dollar is up doesn't mean equity markets have to go down. There are all kinds of factors which are causing equity markets to go down. And in this case, you have to remember the dollar, it's based on a basket of other currencies. So the DXY can go up as long as other fiat currencies in the basket are being weakened. And we're in a macro situation where so many people have demand for the US dollar versus a lot of those other currencies, not the least of which is the chaos in Europe regarding the Russia-Ukraine war and all the energy situations and all that stuff. And so there's a huge, macro demand for dollars right now. And with the, cost of capital going up, if I were to, go look at, here we have junk bonds, which are usually the higher yield bonds there, heading down. The TIPS, which is the Treasury bond ETF, is heading down. That's just indicative of the fact that people are selling Treasury bonds, and that's, their yields are going up. And then when you look at the credit spreads, and the credit spreads are curling to the upside. And so the point is that the cost of capital is going up. And because the cost of capital is going up, the safest thing to do is not to borrow, but to to get those dollars in hand. And so there's a huge amount of demand for dollars because it's, in this case, in this kind of environment, it's better to hold the dollars than to have to borrow dollars, which will cost you more in the long run. So you don't want to be borrowing dollars in order to buy assets right now. You want to be buying dollars, at least in this kind of environment. And that's, again, just using the typical logic from the way that these things work with credit and all that and yields and all that kind of stuff. So my point is that people are not paying enough attention to all the macro. There's nothing on this picture. So if you're just looking at the technicals, there's nothing here that suggests that the dollar is going to suddenly reverse, and that we're topping. I was talking about this recently on Twitter, all in here, I was saying this was a flag, something like that, right? That's what I was saying. If you were following my channel, you heard me talking about that. But so many people were saying, oh, the dollar's topping. And well, here we are 5% higher than, April was a 5% up month. So There you go. How do you like them apples? So there's nothing technically which suggests that the dollar is going to reverse and that we're topping. Fundamentally, a lot of people can't wrap their minds around the fact that even if the dollar is losing its purchasing power, it doesn't mean that it's losing its strength versus other fiat currencies, particularly those in its basket. And that's what it's all about. So there's not even a whole lot fundamentally which suggests that the dollar is going to reverse trend. And we're in a macro situation where the Fed is tightening, and they're eventually going to start pulling liquidity out of the system. So it's really important that you consider that. Now, could we spend some time consolidating here? Actually, I think that's what we will do. If on Monday, if we don't take back this parabolic trend line, then I could totally see a little bit of a pause, and then the FOMC meeting will affect the dollar one way or another. Maybe we come down and retest this trend line. Maybe we consolidate through here and then eventually take back off. And again, I'm no expert, so but to me, what I'm looking at is I'm looking for, let me see if I can get out here enough. Let me pull this down. So I'm actually looking for a range. So here we are at about 103-ish. My range that I'm looking at as a target is essentially somewhere in this range. I know it's a big range, but I think it could easily get up in here. I think it's going to get over 105, but how far above 105, I'm not sure. If we get into a crisis situation, excuse me a second. If we get into a crisis situation, then I think we'll get into the higher end of that, because I suspect the rush to dollars will look quite a bit like this, where after we got that sell-off, the dollar just spiked up extremely high. And if you think back to that time, that spike was almost 8% in 9 days, which, it took us, almost a whole month to go 5%. So, so anyway, that's kind of my outlook on the dollar. Let me take a look at the 10-year Treasury yield. A lot of people have been watching this trend line. It did break, and we are now looking for a retest. Obviously, the line to watch is right here. So if we make a lower low, if we fail to make, well, actually, we're closing right at about the same spot. Let me see this candle really quick. So our close is 2.939%. Yeah, and we closed 0.001% lower than here. So if we can make a higher high and close higher, then yields are going to just continue to skyrocket up. If we roll over into next week, and then with the FOMC meeting, if the decisions that they make have a negative impact on yields, then we could see them cool off a bit. But there are a lot of different trend lines that I'm watching, which might provide some support, both local as well as long term. So we have to address that when it comes. So once again, the line that we're watching is, oh man, that was really awful. Sorry. The line that we're watching is somewhere around there to see if we make a lower low. And again, people on yields are looking for a reversal. And the biggest thing is everybody is looking for what they want, not for what is being shown to them. So that's something to pay attention to. Gold kind of is not doing so hot. It actually looks very similar, a little bit more prolonged, I think, in timing, but it looks very similar to what was going on after we spiked up in August of 2020. Got a spike, came down, we consolidated, we're making a lower low. I had been talking about how being above 1967 was bullish, being below 1916 was bearish, or more bearish, I should say. Well, we came below 1916, we got rejected today at the 1916 level, and we're closing at 1896 today. So now we're stuck in this range between 1916 on the top side and 1875 on the bottom side, which has been also a fairly important level going back across the last 2 years. So gold's a little bit sad to watch at this point. Oil, I would just like to take an opportunity to show you guys this because in my newsletter, I think it was not this most recent newsletter, I think it was the one before that, I'm not 100% certain though, but I talked about spending a few weeks cooling off in a range between 115 and 93, and that the 382 Fibonacci level was going to be the next resistance to reject price. And so the chart, when we look at the chart, you'll see that I was talking about that when I mentioned that we were right there, and then we obviously got rejected, came down, we got rejected again. And what I thought was interesting is I threw this trend line, this white trend line here, and what I was looking to see is would we get over it, and I actually thought, it looked like we were. On the 8-hour chart we got above it, but we got rejected. You can see a clean rejection right there and closed below. So what I predicted, you can kind of see on my squiggly line here. This is kind of what I'm looking for to happen. And it could take months, it could take weeks, it could take days. I don't really know, but I do think the macro backdrop is good for oil. I just think that with all the energy shortages and with the way that ESG has just destroyed interest in oil exploration and all that kind of stuff in oil investment, I see price going up. I know that there are others like Eric Townsend from Macro Voices that believe that and have been saying that for some time. That's kind of what I think is going to happen specifically with oil. And commodities in general are going to be kind of the trade of the decade, I think, especially with inflation as it is. Silver, we don't really need to look at silver because I already talked about gold. Silver is still stuck in its sideways range. We are in between two really important levels. The low here at 2147 is going to be really crucial to hold. And then finally Bitcoin, it's not looking so good. I put a couple of trend lines in. Let me go to my 8-hour here. I put a couple of trend lines in. I think it's interesting. We wicked above this trend line. This is a very aggressive line of repair. We broke above it, but then closed below. I actually remember this April 28th, yesterday this week, was crazy. Just this one 8-hour candle, we came up, and then we came down, and then we came up. And then this second candle came up, and then down, and then up, and then down. So it was really crazy. And so what I'm going to be watching, a lot of people are already covering this in the crypto world. We have to watch to see if we make lower lows than kind of these closing lows right here. That's obviously going to be bearish if we do. I think because of the view that I have on the equity markets going into the FOMC and some of the, and then the non-farm payrolls and then the CPI, I suspect that it's going to be really important to consider that Bitcoin in the near term may be heading further downward. But nobody really knows. That's just something I'm watching for and I'm aware of. Long term, still bullish on Bitcoin. Definitely believe in it. So don't take me as like I'm not selling my Bitcoin. I'm still holding my full position, full disclosure. But I'm just telling you in the near term. I mean, like if you got in at the right time, like people, I understand obviously if you bought Bitcoin around these peaks, then obviously you're underwater and it's really hard to be patient. But if you got in at the right time, then this is definitely a time to just hold strong and maybe even just put away your charts and get off Twitter and stuff like that and come back in a couple months or a couple weeks or whatever, or maybe even a couple years, because nobody that's held Bitcoin for 4 years has lost money. So that's where I'm going to leave it for today. If you subscribe to this channel, thank you. Please hit the like button, share this channel and this video with somebody who you think might find it helpful. Subscribe to my newsletter. If it's something you're interested in, you can find it on my profile page on Twitter at Mr. J. Thomason. And with that, I'll leave you for this week. I hope you have a great weekend. Be safe out there, and I will see you guys next week in May.